Okay, good afternoon, everyone. It's noontime, and let's begin with the webinar. Today, we will be talking about the so-called One Big Beautiful Bill Act that recently passed Congress. It's a sweeping piece of legislation. There's a lot in it. We're going to be focused today on exclusively really the agricultural provisions of the bill and the tax implications and so forth as they relate to Northeast agriculture. Of course, this bill has significant touches on significant broad aspects of America and American society and law, and it's beyond, many of the provisions are beyond the scope of what we'll be talking about today. Today we'll be having Dario Arezzo speaking about the agricultural provisions of the OBB, as it is called. I just want to present a disclaimer that the information provided in this webinar is not intended to be investment, tax, or legal advice. We are presenting the information in good faith and as best as we can interpret the regulations, but we have to include that disclaimer, of course. Dario Arezzo is the Chief Financial Services Officer of Farm Credit East. He is has a wealth of knowledge on agricultural tax law, policy. There's so much I could say, but in the interest of time, let's get started. I will change the presenter to Dario and let him share his slides, and then we can kick it off.
Hey, thank you, Chris. Are you able to see my screen?
We see your work view of the you want to. And then we see your presenter view.
So you see my presenter view right now? Okay, how does that look? Does that look good?
That's perfect. We see the slides only.
All right, thank you so much, Chris, and appreciate the introduction. Your apologies for the webcam not currently working, but that's okay. I assure you the material is much more beneficial than looking at myself here. And Jeremy Ferret is also on the call, our retail financial services leader. He will round out the back end of this presentation with some important crop insurance provisions. As Chris mentioned, a lot to cover here. We're not going to hit it all, but we'll hit the highlights and leave some room at the end for questions. For those questions that we don't get to, you can submit them to Chris, myself, and Jeremy, and we'll provide contact information at the end of the webinar for that, and we'll get you the answers that you have afterwards. But I just want to thank all of our customers that are on this webinar. We do have a significant amount of current and hopefully future customers. We know you have choices for your credit, tax, consultative, crop insurance needs, and we are grateful that you choose us as a provider. So to get going here, nothing new regarding the qualified business income deduction. This has been made permanent from the bill, and there's no change for farmers here. This is that 20% deduction that farmers get. At a real simple fashion, what you're seeing on the screen is you figure out your net income. Let's say if you're a dairy producer and you exclude your cull cows, you add your equipment sales, you come up with a number and you multiply it by 20%. You apply it to any farming industry. That's how the deduction works. It's very beneficial, and it is now made permanent, along with the flow through that if you're a member of a cooperative, you're seeing on the screen here, that yellow box, you get some of these deductions from your co-op. Those deductions, were great to see them be permanent, because otherwise that would have thrown a big wrench into producer entity selection. A new provision in this bill is the ability to spread your tax out over 4 years if you are a certain qualified seller of farmland selling to a qualified farmer. And we'll get into that, but a pretty nice provision where you sell land, you got to pay tax in the year that you sell it, unless you have an installment sale, of course. But now this provision is a little bit more beneficial for those looking to get that sale up in year one. Let's say you got a $4 million land sale and you have $750,000 due on April 2027. The options are you can either pay all the tax up front, or you can spread that tax out over a period of 4 years. And if you get out your fancy math calculators and do some plug in some discount rates, you can see there's a pretty substantial present value savings from a tax standpoint. So it is a very good new piece of legislation that can, I would say, help mitigate the lock-in effect. And what I mean by the lock-in effect is, typically folks may hold land for a long time because they don't want to pay the tax associated with selling the land. But with this, I believe this will ease those concerns a little bit, because there is some benefits, as you see on the screen here, regarding this new tax deduction. A couple important things to point out with it is, you can only defer the tax on the farmland sale. So that red number on your screen, 387,500, if you have more tax than just the farmland, the additional tax from non-farmland is still due in the year of which you've incurred it. But then the other portions of the farmland, you can see, are spread out. What are some of the rules around this? You got to sell qualified farmland, and we'll get into that, to a qualified farmer. And then you have those 4 payment streams, as we just went through on the previous slide. What is qualified farmland? It's got to meet a couple different provisions there. Either have been used by the taxpayer as a farm for farming purposes, or you lease the land to qualified a farmer that's been kind of doing farming on the land for most of the 10-year period. Don't really know exactly what substantially all means technically at this point, but probably for the majority of those 10 years. And under that leasing part of it, it's got to continue in farming for a decade under a covenant or other restriction. And that does entail some reporting requirements that go along with that piece of preclusion there for keeping that land in use for farming for 10 years. You may need to attach, for example, something to the tax return. A qualified farmer is defined here as somebody that's actively engaged in farming. And that definition really ties to some of the definitions around the crop insurance provisions here, but you got to make contributions of land, capital, time, etc. there. Those regulations are up there on your screen, not here to get into the nitty gritty of it, but the key is you have to be an actively engaged farmer as defined here in the Food Security Act of 1986. Some good news on the estate planning front. Right beginning in 2026, the estate tax now is made permanent for those higher thresholds. That $15 million exemption, or $30 million per couple, beginning in 26. You still do have to be aware, I would say, of state estate considerations. Don't take this as an opportunity to do nothing for estate and succession planning, because you may still have a decent tax bite down at the state level. And also, this does, I believe, change some of the calculations regarding discount planning. A lot of folks over the last 12, 18 months were doing some planning in anticipation of those federal exemptions going lower, and have incurred some decent discounts in their planning documents, where now you may want to reconsider those or take a second look at them based on the permanency of the estate tax. And just for reference, on your screen there, you can just take a little bit of a flavor of what some of the states here in our territory look like from a estate tax consideration. New Jersey, Pennsylvania, no estate taxes, but they have an inheritance tax, for example. So I didn't put those on the slide there, but just a little flavor of what those numbers look like as of today. And you can see my point regarding the different threshold amounts. Also, there's different state considerations around what's called portability, as far as a spouse dying and giving their surviving spouse the ability to use their exemptions. So like in New York State, for example, that's not allowed. So planning is still involved, is the point to take away here, but we can just rest a little bit easier with that higher $15 million per person amount. And as you think about the planning with regard to that higher estate threshold, you look at the side stick figure I like to use. Somebody passes away and junior inherits all the stuff. That ties back to my point on discount planning of it may make sense to optimize these larger estate values for basis step-ups, because one of the things that producers oftentimes don't consider is when you do have decent discounts built into your operating models for estate purposes, that does also reduce the ultimate valuation that you have upon a passing, because you have to incorporate those discounts both on the up and down sides here. And so just thinking about estate planning being closely aligned with income tax planning, I would say remains a critical point of consideration for producers. Moving on to a provision, this is really applicable 163J for larger producers on the call. Typically kicks in if you are over 31 million gross revenue for the prior 3 tax years. But if you're in that bucket, and that number goes up with inflation every year a little bit, if you're in that bucket, a big change that's material, which is the way they calculate that limitation. And you can see, right, the 3 bullet points on the screen there of what the limitation is capped at. So in other words, you can't deduct interest if it's more than your business interest income plus your 30% of ATI, adjusted taxable income, and some floor plan financing provisions as well that aren't really applicable to most producers, but for some people that have inventories and such. The key there is that it used to be on an EBIT method for the last couple of years, earnings before interest and taxes. Now it's kicking back in depreciation and amortization. So back to an EBITDA standard, which is much more favorable for producers that are in this bucket. A couple ancillary points here is that there are some, if you are on the call and you have foreign income, there are some unfavorable changes there in the ATI space regarding subpart F and GILTI inclusions. And the other piece here that was interesting is that under the big beautiful bill, this limitation now for 163J is going to apply before the interest capitalization rules, which is, appears to be an unfavorable change for taxpayers. So the ordering rules of how this 163J interacts with the interest capitalization rules could be something to take a deep look at if you are in this bucket. As made popular right throughout political talks here, there is a reduced tax, I would say, on overtime, not elimination of it, but a reduced tax of up to $25,000 if you're married filing jointly on overtime. There are income limitation thresholds, $150 or $300,000, depending on if you're single or married filing jointly. The next few years, will be in place. There'll be reporting requirements on the overtime, making sure it's reported properly on W-2s and as such. And the important part here I wanted to point out is the last sentence regarding it's got to be required overtime under the FLSA, Fair Labor Standards Act. And typically, right, and under that act federally, a lot of industries, including agriculture, aren't subject to overtime. So just the point there is don't look at the overtime if you're somebody that's getting overtime. Depending on what industry that person is in, they may not be eligible for this reduced tax on overtime because they tied it to that section of the FLSA because they don't want everybody now recharacterizing the what is overtime and paying overtime to kind of get some benefits to the individual taxpayer who may be in this bucket here. There's also a reduced tax on tips up to $25,000. These qualified tips, excuse me, are reported on by your W-2 or your 1099s, etc. Available for years 25 through 28. Again, there are income limitations here, depending on if you're single or married filing jointly. $300,000 again for the married filing jointly. And the Secretary of the Treasury was supposed to publish a list of traditional tip receiving occupations within 90 days of this bill. So more to come there on occupations that are going to be qualifying for this. But qualified tips are kind of what you'd customarily think of as, how they use in the language of, quote, traditionally and customarily received tips, as we knew that language on or before December 31st, 24. So more guidance to come here regarding exactly who is eligible for this reduced tax on tips. Well, while there's no Social Security tax elimination, this next deduction is for those 65 and older. This is meant to be that no tax on Social Security. In other words, there's a $6,000 deduction if you're 65 or older as a tax filer for the next few years here as well. Whether you itemized or not is irrelevant. And again, you can see some income limitations there on the third line regarding taxable income there. But this is an important deduction for farmers, particularly those, right? It goes back to tax planning, I would say, is if you get these enhanced deductions, think about that as you do your annual tax planning. with your advisors here, because if you're going to get an extra 12 grand as a married couple, let's say that are both over 65 years old, then you have the ability to take on some more income, perhaps if you're still part of a farming operation, and have that deduction, reduce your additional farm income. So some decent planning pointers there. Depreciation was a big win for farmers in the bill here. On the left side of the box, you can see section 179. The IRS characterizes property by class life. So typically most things I would say are in that 3 to 15 year property. That's basically everything but general purpose barns for all intents and purposes on a farm. General purpose barns are typically a 20-year property, but those deduction limits have greatly been enhanced. So now it's a $2 million limit and up to $4 million of investment in qualified property. So those are significantly up from the past year. Bonus depreciation, which is, you can see, allowed for all properties as well as those general purpose barns, where section 179 is not allowed for those general purpose barns. Bonus depreciation, that 20-year property in blue there, that's a general purpose barn, and you can use this deduction for that up to 100%. There is a transitional rule to note that you can elect this year, and I should note for the bonus depreciation being 100%, there's a little kind of quirk in there that it's after the January 19th, so basically, upon the presidential inauguration there. So, January 19th is an important date where if you bought a 10 million bucks of stuff on January 1st, for example, that's not going to be helpful for you for the 100% bonus, but the 119 date is in the rules. But you can elect for this year under this transitional rule either 100% or 40%, which does increase optionality for tax planning. An important point to keep in mind too, if you're a fruit grower, is that this does include plantings or graftings. So like orchards, vineyards, for example, you plant your tree, you can take 100% special depreciation under the tax rules in the year that you plant, as opposed to, historically, for those of us doing this long enough, you had to wait until those trees became commercially viable. Not the case with bonus depreciation upon planting of the tree. There's also a new section in here for bonus depreciation regarding really like manufacturing production facilities. Typically, if you have a commercial building, those are 39-year asset classes. So in other words, you have to expense that over 39 years. There's this new category under the tax rules in 168 that allows for 100% depreciation for these qualified production properties. And this includes manufacturing, agricultural, chemical production, or refining of tangible personal property. So just be aware there, if you are it's related to the manufacturing process in some way, that there are some more expanded tools here regarding this new separate of bonus depreciation. And again, just an example here, if you're let's say a vineyard or a grower, that year one planting of your vines, your posts, you can expense those in that black box at the bottom there, 100%, as long as they were incurred after January 19th of 2025 there. So a nice ability to recoup that if you so choose. I would say this is a massive win for those of you on the call from New York State, our customers in New York. This makes tax planning a lot easier, because as you look at the example on the screen there, really all things being considered, those of you in New York know that there's a 20% investment tax credit. The key with that credit is you can't pay section 179 on the asset and get the 20%. So now with bonus being back up to 100%, it does make tax planning a lot easier. There are still nuances there because there's different rules that we just don't have the time to get to, unfortunately, between bonus and section 179. But the ability to use 100% bonus depreciation at the New York State level is going to significantly increase the flexibility for producers to get their federal depreciation deductions, as well as optimize their investment tax credit. And for those of you that are not in New York, but that are in the state of Maine and Connecticut, a lot of enhanced similar credit opportunities to that ITC and some other things at the state level that are important to be aware of, that these now federal deductions also help the overall tax planning. So if you're in Maine or Connecticut, make sure you reach out to your your farm credit relationship manager so that they can make sure you're aware of those things as well. But I don't want to leave any other states out here. Being that I'm in New York, I want to let you know that Maine and Connecticut do have some really nice provisions here too as well. Particularly Connecticut beginning in 2026, Maine 2025. That farm credit's going to help create some unique strategies for as part of that legislative process in both of those states. A few various provisions here to make you aware of. The child tax credit has been enhanced. So there are income limitations with that, but typically $2,200 now a kid in 25 for the enhanced child tax credit, of which 1,700 is refundable. 400 grand is where it begins to phase out from a married filing jointly couple. But that has been enhanced, which is good news. The mortgage interest deduction up to $750,000, that's been made permanent there. So that you buy a house or you use that, right? You get a loan to buy your home and you want to expense the interest, etc. That's what that's inferring to. Obviously, if you take out a $3 million loan, that's why there's that cap of 750. So just being aware of the cap is important. Beginning in 2026, mortgage insurance premiums do qualify as a qualified resident income. There's a new provision that you've probably read in the Wall Street Journal or other publications regarding certain passenger vehicles. You can deduct up to $10,000 of interest. There's a decent amount of restrictions around that. There's income limitations. For example, if you're $150,000 of income for a single or $250,000 for a married taxpayer, there's phase outs. It's for the next 3 years, 25 to 28. And there are only certain vehicles are eligible for that as well. So like a lot of things in the tax code, the devil's in the details there, but just wanted to make folks aware that there is a new provision in that. And the other thing to make you aware of is some of the clean energy stuff for the tax credits. For example, the electric vehicles, that's going to expire after September. Charging station credits after June of 2026. There's some energy efficient home improvement credits. Those also expire in 25. So just be aware that some of those things that you may be familiar with, as far as tax credits at the personal level for cars or for homes, those things, a lot of them have gotten truncated and reduced as far as when they are able to be utilized by taxpayers. Important provision from I would say the Northeast delegation of Congress that they heard a lot about from the representatives regarding the state and local tax deduction, the SALT, as it's been called in the news. Up until this legislation, if you had 30, 40 grand of income taxes due to the state, you couldn't deduct over $10,000 of that. That's now been expanded up to $40,000, little inflation kicker there. But there is a $500,000 income limitation to the expanded SALT provision. The pass-through entity tax, the PTET, for those of you that have states that you're in business in that have PTET regimes, those still may make sense. As you can see on the screen there, maybe you have 10 grand of real estate taxes, 30 grand of state income taxes derived from your business and some charitable contributions. Now you can fully deduct as that individual that 45 grand of itemized deductions there, but you still may be better off with the PTET. If that 30 grand of income taxes came from your spousal multi-member LLC, for example, maybe you're better off doing the PTET still and claiming the $31,500 standard deduction. Other factors include, right, local state incentives, right? Connecticut, Maine, New York, other states there that have different incentives. PTET may or may not make sense, but the key here is that it's worth understanding your individual circumstances around the enhanced SALT deduction and how it interacts with your business regarding what the best thing is to do for state tax considerations. The employee retention credit, a lot of truncation down here. So for Q3 and Q4 claims after January 31st, 2024, those have been now disallowed. So we just got to be aware of those, that the bill did disallow certain claims. And so if you're in that boat, you may need to kind of look at maybe amending or looking at where you fall in that. The other piece to point out here is that the statute of limitations did also get extended a little bit too. So the ERC enforcement is likely not over as far as IRS looking at this credit because as we all know, a lot of liberties across the country in this space there. So they continue to modify and tinker with the statute of limitations regarding how long the IRS can audit a tax return in this space, right? The typical statute of limitations is a 3-year statute for the most part, but in this case, it's a 6-year statute. So being aware of that is important. There's a new Trump account, if you haven't heard of these. What I wanted to do here on the screen, not going to go over the slide to you, but the point here is that if you have a baby that was born from 25 to 28, you're going to get $1,000 seed money into this account. At its very simplest explanation is how I think about this. I view them as a non-deductible traditional IRA for those under 18 that their parents can put $5,000 a year into without the kid having to have earned income. That's basically how I would frame these up because they fall under the IRA rules. And the point of the slide that you're looking at is maybe it doesn't make sense in all cases to have this account. If you're going to use things for college, maybe use a 529 account. Maybe you prefer the flexibility of a brokerage account. So you have a UGMA account, for example. So just, again, another piece of the tasker where it could be a very useful tool for getting your kids a head start on their retirement. But you got to look at your individual goals, how much money you have available to save for their retirement or your own retirement or their college, et cetera there, and figure out which type of vehicle best suits your needs as a taxpayer. Some 1099 reporting rule differences here. You can see in 2026 for the 1099 NECs, that threshold is going to be bumped up to $2,000. Also, for those of you that have to deal with 1099Ks, either giving or receiving, you can see on the screen as well that those thresholds have also been kicked up here. Charitable deductions, for non-itemizers beginning in 26, you can see there's $1,000 or $2,000 deduction depending on your filing status. So you'll have to provide your receipts to your tax preparer for those things here. There's also a floor for individuals as well as corporations. I didn't put that in the slide there, but there's a 1% corporate floor for charitable contributions as well. And then there are also modified what's called P's limitations for those that are in the highest tax bracket. Basically, you don't get the full bang for the buck of your charitable contributions there. It's calculated at basically the 35% rate, not 37% is how the formula works. So some important changes there regarding charitable deductions. For C corporations, the qualified small business stock exclusion from tax has been greatly enhanced. Now, just a point here to clarify, farming businesses, if you look at what types of industries qualify for this, farming is precluded, but I put it on the slide here because many of you have ancillary businesses beyond farming, right, trucking, et cetera, that could be germane to this deduction here, or I'm sorry, this exclusion from gain, not deduction. For the qualified small business stock exclusion, that involves C corporations. There's a lot of nuanced rules around this exclusion here, but my only point is that it's been much more enhanced than what it used to be. And some of you on this call may have businesses that are in C corps that aren't in actual farming, but ancillary to, that could significantly benefit from this expanded QSBS exclusion. Similarly, there's a decent amount of folks that may have interest in qualified opportunity zones. Basically, at its simplest level, if you sell capital gain assets, you can defer tax by deploying those funds into a qualified opportunity zone, which is essentially a census tract that will be designated from respective states. And by July 1st of 2026, states will create these new opportunity zone tracks. You'll have to think about the timing rules there because there's kind of a gap between 26 being a dead year and then 2027. So being aware of these new zones, waiting to see what these states look at for what they're going to designate as these new zones. And the key that's also been enhanced here is that there's a rural kicker where there's some more perks in the bill for investing in rural areas. So we'll see what areas they come up with at the state level here. But basically, think of this as you sell a capital gain asset. Under the tax rules, there are opportunities to defer that money by investing into targeted areas that you can create a business such as farming, for example, to mitigate the tax on your sale of stock, for instance. If you sold a bunch of stock to kind of deploy into a farming business, this could be a really nice vehicle for taking a look at what this looks like. So a lot of considerations here. Along with these enhanced benefits, I will note that there's going to be significant reporting enhancement requirements. We don't know yet what they look like, but because they've enhanced the sweetness of these QOZs, qualified opportunity zones, the reporting has gotten much more stringent. And they're going to be looking at making sure that everybody that is involved with these does the proper reporting or faces significant penalties with regard to obligations of not reporting in the proper way. So I am sure we'll have more guidance coming out from IRS Treasury on this year, but if this applies to you, more to come as far as what those reporting requirements will look like. Section 45Z of the tax code provides a per gallon tax credit for fuel producers who generate clean transportation fuels with a certain carbon intensity score below a targeted threshold there. The lower the score, the higher the credit. Even though this credit's paid to fuel producers, farmers play a role here because they can supply these low carbon intensity feedstocks to these producers. And so in other words, they may be able to get a premium on what they're growing by giving it to some of these producers who qualify for the 45Z credit, which has been extended through 2029. And they've also narrowed down the feedstocks. Now they have to be feedstocks produced or grown in North America, right? US, Canada, Mexico. That wasn't the case prior to changes here in the legislation. And then the last slide that I'll point out here before turning it over to Jeremy Ferret is one of the pieces that I noticed in this bill here as I was reading over the 4th of July. If you look at the Higher Education Act exemption of assets now, this is really good news for farm families, also commercial fishing businesses, because as part of your student aid eligibility, they're going to exclude assets from these small family-owned businesses, which could be a really boon to our farm families here in the Northeast. So something important to keep aware of and make sure that you're right. As you have kids going to college or in the middle of these aid awards, to be aware of these new rules within the One Big Beautiful Bill. Jeremy, can you hear me now? If you can, I'm going to turn it over to you. If you can unmute yourself.
Okay, sounds great, Dario. Can you hear me?
Yes, you sound great.
Okay, excellent. Thank you. First of all, as we, let's see here. Share
Hey,
my...
Chris, if you want to keep my screen, or is Jeremy going to share his screen? Okay.
I'm going to share. Let me know if you can see.
Yeah, perfect. Your screen looks great.
Fantastic. Okay. Thank you, Dario, for that overview. I'm going to dive into farm programs, FSA, Farm Service Agency programs, as well as the federal crop insurance program. And just a couple of points here. The Farm Safety Net had many big wins with the One Big Beautiful Bill. The last time that crop insurance experienced sweeping program improvements like this was in 2000 with the Agricultural Risk Protection Act, ARPA. And that was when Congress really committed to the federal crop insurance program with significant support. And we're going to talk about how this year is once again a catalyst to improved risk management. And to give a quick background on crop insurance in the Northeast, so our 8-state area for Farm Credit East, crop insurance is the backbone of Northeast agriculture, ensuring 1.6 million acres, protecting $1.8 billion. And since 2020, Northeast farmers have paid into the crop insurance program $250 million in premiums, and due to weather-related, market-related losses, received over $520 million in claim payments. So the plans that you have in place, they are making a significant difference and impact on the financial well-being of your business. And the One Big Beautiful Bill really builds on that to give you more options, make coverage more affordable, and we're going to dive into what that means specifically to you. And I'll start with the Farm Service Agency program overhauls. And one of the big ones is the increase from $125,000 payment limitation to $155,000. Looking at the investment, looking at what's program payments and what is needed on farm, this is a good positive improvement. The other one is for pass-through entities, and this is really important as it relates to S Corps and LLCs, will now be treated similarly to general partnerships. So this is another improvement. The other one is if you have greater than 75% of your adjusted gross income from farming, ranching, agriculture, the $900,000 AGI limit is not applicable. So this is really important. The other one, as you think about planning for 26 and you look at your entity structure, be talking with the Farm Credit's tax team, be talking with the business consultants, understanding how farm programs and your entity structure can work together to benefit from these programs, extremely important. Moving over to the crop insurance program and affordability, this again goes back to that major commitment by Congress. You can see the different coverage levels, anywhere from 50 to 85% coverage levels. You can see where the rates of premium support were in 2025. And now we see the commitment and increase in premium support, making coverage more affordable to you. Keeping in mind, this is the revenue protection and yield protection, that's the RPYP, and the basic and optional unit structure. So right now, if you're an operation and you have what's known as enterprise unit, you may be getting 80% subsidy because of that enterprise unit structure. But for basic and optional units where you break up the farm into different locations, you can see that your premium is going to decrease going into 2026, but also this will allow you to increase coverage and may be able to stay at that same coverage level, increase the coverage level actually. So shifting over to what this means specifically for an example for you, let's say if you have 75% coverage level, and the subsidy is 60%, and the liability amount of protection, $650 per acre. If the total premium was $40 per acre, and that premium support is $23, now you're looking at producer premium, farmer paid premium of $17 per acre. So again, pretty significant commitment. Definitely worth re-looking at your coverage level as you plan for the 2026 crop year. This is a really important type of coverage. We've seen significant growth in supplemental coverage options, enhanced coverage options, and these are area-based coverages which allow you to insure up to 90% for the supplemental coverage and up to 95% coverage under the enhanced coverage level, coverage option. But here's really some of the big takeaways. You can see that increase in subsidy, that increase in premium support. So the old premium support was 80%, 65%, now it's 80%. So this policy, what it does for your farm business, it allows you to increase the coverage level. Yes, it may not be specific to your farm, but it's going to be an area, depending on whether it's the county or maybe a couple of counties that have similarities. I would say take a look at your coverage for 2026, reevaluate if you don't currently have the supplemental coverage option, reevaluate, is this going to allow you to increase your protection, reduce your risk, benefit from the increased premium support, and keep your premiums affordable? This, I would say, talk with your crop growers, Farm Credit East crop growers agent. They'll walk you right through how supplemental coverage or the enhanced coverage level can help support your investment. This is another significant benefit as we see more and more young beginning, small, new farms entering agriculture, especially in the Northeast. This has been on our request list for the Risk Management Agency for about the last 5 or so years. And this increases the time span from 5 years for beginning farmer and rancher benefits to now 10 years. And then it also increases the premium support, making coverage more affordable for that new producer entering into agriculture when they may have a lot more risk. They're investing in the operation. So this was a request that Farm Credit East and crop growers has worked very closely with the Risk Management Agency on, and very pleased to see this commitment. And it's certainly going to have a positive impact on new beginning farmers, and hopefully be able to help mitigate their risk as they start out their businesses. Shifting gears back to the Farm Service Agency here and the dairy margin coverage. This was, again, a demonstration of Congress's commitment to the dairy industry. Really pleased. Number one, the program has been extended through 2031. Also recognizing that for sustainability, for viability, dairy operations have continued to increase in size, and the tier 1 production has moved from 5 million pounds to 6 million pounds for that coverage level. So something definitely to reconsider as you look at protecting your margin and as we look at volatility in dairy markets. The other one is providing another opportunity to update your production. And this was extremely important, especially looking at where that baseline had been established, and now the opportunity to reevaluate 21 and 23 in that discussion. So that will be between you and the Farm Service Agency, and discussing how do we increase your production to a more relevant production to what you're producing today. And then also additional premium discount, so 25% premium discount for that multi-year enrollment. So significant commitment to dairy margin coverage. As Farm Credit East and crop growers, we believe in both the dairy margin coverage program as well as a sound dairy revenue protection program as well. Shifting over, as we watch what has been going on with commodity prices since reference prices were established, you'll see that Congress recognized that whether it's corn, soybeans, barley, they've recognized the increase in market price and have made adjustments to reflect that. These prices will impact your decision with the agricultural risk coverage. So these are FSA programs, or the price loss coverage. So again, as you look at program decisions for 2026, you'll start to see these prices take effect, and you'll start to see that hopefully they're more in line with what the market is providing today. So a positive impact here. And then the other one is, and looking back at the last time that we had an opportunity to update base acres, and I was reviewing the last farm bill that allowed us to update base acres, and that was 2002. So it's been 23 years since we've had the opportunity, and this is going to be an initiative from the Farm Service Agency issuing letters in early 26, and what they'll have is a proposed new base acres based on the planting of 2019 and 2023. and then you'll be able to make your election at the Farm Service Agency in 2026. So be on the lookout for that letter. This is a very important opportunity. We've been asking for an increase in base acres, and it will be prorated based on the $30 million, or pardon me, 30 million base acres that have been allowed, but great opportunity, certainly. So where do we go from here? These were just a few of the highlights of the farm program changes that have taken place and improvements that have taken place with the One Big Beautiful Bill. And the real next step here is to work with whether it's the crop insurance program improvements or it's the tax program benefits that you've heard. A lot of this is going to require leveraging specialists, leveraging the knowledge of your experts, your team, and this is where the Farm Credit Ease team comes into play, and this is where we're committed to supporting you. And number one, understanding the program improvements and making sure that you get the benefit of the program improvements. So whether it's crop insurance changes and enhancements, work with your crop growers, crop insurance agent, and if it's anything on the financial side, you've got a financial services team of experts from tax to business consulting to all of our services that we have to offer. We're here to help you navigate the new bill and make the best decision for your business. Finishing out, all of the material that we talked about today and some more resources will be made available at our website, public website, and the recording will be made available here in the next day or so. And we'll continue to publish information to help you stay on top of the program changes, the improvements, enhancements, so that you are equipped to make the best business decision, understanding all of the details. Great. With that, Daria, I believe we're going to turn it over to question and answer, and hopefully looks like we've provided about 15 minutes or so for question and answers.
Yeah, we do have a few questions. Can you hear me okay, Dario and Jeremy?
Coming through clear.
Yeah, can hear you loud and clear.
Okay. So a couple that have come in. One was regarding the overtime limited tax exemption, if you will. You mentioned that it's only for required overtime. Now, we have an issue in the Northeast in particular where many states are requiring overtime, even though it's not federally required. So how does that sort out? Would the overtime, like in New York, for example, be considered required overtime or not, or do we know?
Sure, great question. So just as a rehash there, the mitigation on the overtime taxes for that employee getting the overtime. So the worker that has the ability to reduce their taxable income based on overtime that worker is incurring. Now, the key part to your question, Chris, regards what's applicable for that. And it has to be required overtime under the Fair Labor Act. And so to the extent that the overtime is not required under the federal act, then that worker would not be eligible for that. So yeah, it appears like in New York, for example, if it's required by the state, not by the federal law, then that worker would not be able to avail themselves of that, because you got to look closely at the Section 7 of the FLSA to see who exactly is eligible as that worker that you pay. On the business side of things, there's no business benefit as the employer paying it, but it's other than obviously like you mentioned New York, there can be state credits depending on the state that somebody resides in for the overtime, but it's really the worker who's paying tax on their wage. What can they benefit from? So yeah, great question, Chris.
Okay, yeah, another question that I'd like to ask you to discuss is maybe to some extent talk about the impacts on smaller producers. Most of the impacts that are happening as part of this Big Beautiful Bill Act definitely the benefits accrue to large, more significant taxpayers for sure. But I think there are some things that would benefit even smaller taxpayers, correct?
Yeah, that's absolutely. So a couple of things, if you're a smaller producer, uh, if you're showing profitable income, the 20% deduction, that qualified business income, the QBI, that certainly is a decent tax savings to you. The ability to use bonus depreciation if you're going to plant something on 1,500 acres of some orchards, some vineyards, that certainly is another applicable provision for you. And in addition, I didn't mention it at the outset, but the individual rates that a small producer would pay, those lower rates have become permanent here, so they didn't increase as they were set to expire at the end of the year here. And so you couple those together, Chris, and certainly all producers in one way or another benefit from some of these provisions.
Yeah, I mean, and just to call it a couple of things, and correct me if I'm wrong on any of this, but even smaller capital investments would benefit from some of the bonus depreciation benefits, correct?
100%.
And for people's individual tax returns, if they have an NS Corp or a LLC or if they're just a sole proprietor, things like the SALT deduction increasing would help them in most Northeast states, I would think.
Yeah, the child tax credits, the ability to deduct vehicle interest, all those things that flow. If you're a small producer, I think you hit on the head, Chris, as it flows down to your individual tax return, it all adds up to see some pretty decent tax savings, regardless of the size of the taxpayer.
Okay, that's good. We're getting a few other questions coming in. I'll give it just a minute to see what any sort of takeaways for people that are struggling to understand all this jargon and tax code references.
Yeah, the key is work with the right people. Your tax advisor should be up to speed on these things. There's a lot in this bill. It was over almost 1,000 pages, I want to say, and a lot of the things today, there's just not the time to go into them in depth. It's the goal today is meant to be an awareness of several of these provisions that certainly can help your business. But most farmers are farmers, right? They are not going through thousands of pages of legislation here to navigate these things. But we'll work with a good team to optimize these things, because as I said with your question previously, Chris, every person on this webinar in one way or another can benefit from some or most of these provisions in the one big beautiful bill.
Another thing was any changes for smaller farm crop insurance, such as the whole farm revenue or micro farm policies, Jeremy?
Yes, thank you. Great question. So there have been some improvements, enhancements to the whole farm revenue protection. I don't have them at my fingertips right now, but what we'll do is we'll put together a blog for our website specifically on the whole farm revenue protection program enhancements. And please encourage everybody to monitor closely the blog. There's a lot of this type of information that we will continue to publish through our blog program. So I will get something out here within the next week specific to the whole farm revenue protection and its program improvements. Great question.
Okay, because specifically regarding the whole farm, which is for mostly diversified, like fruit and vegetable producers or producers that have multiple enterprises on their farm. I think there's been significant changes and improvements in the last, 5 years or so. So if you haven't looked at it recently, you might want to take another look at it.
Yeah, and thank you, Chris. One of the things that we've been working very closely with the risk management agency on regarding that program has been the record keeping requirements. And that's why I want to be a little more specific in the, because they've simplified the record keeping requirements. But I want to use the blog format to get that out to all of our customer base and all of the Northeast agriculture. So I would say keep a lookout there. We'll have that detail to help you understand how did the risk management agency make the record keeping more simple, because that's been something we have been working on for several years. The type of detail that our very diverse operations previously had needed to participate, we knew we needed to work with the risk management agency to slim that down, and they definitely heard us and they've made those type of improvements. I want to be more specific to our audience and our customers.
Okay, fair enough. And I think one of the things that we should mention to some extent is, in the Big Beautiful Bill Act, we're using that term because that's the official name of the bill, right? But not all the provisions in it were good, so to speak. There are some things that are going to negatively impact agriculture to some extent. I think one of them is reduced spending on the SNAP program, which indirectly flows through to farmers in terms of food purchases. I think also the energy credit. What were the sunset dates for those? Was it September? And is that just for electric cars and car charging, or is that all things like solar panels and alternative energy and that sort of thing?
There's a whole slew of them, Chris, that are out there, regarding all the IRA credits.
Okay. And I think we can all agree that there's been a significant dialing back or rescission of a lot of things like renewable energy grants and credits and that sort of thing that are sort of aside from the Big Beautiful Bill, but certainly are affecting farmers as well. Although that's sort of beyond the scope of this discussion.
Well, and Chris, just to go a little bit further, so thanks for bringing up, more of a farm bill type discussion. So while this bill had many improvements in many areas that positively impact agriculture, we still have a farm bill that we are working on and that Congress is working on. And we still have some of that type of whether it's funding, program requirements. I believe that we're going to see more coming out of the Farm Bill. We're hoping to continue to see this momentum of improved farm safety net. Yes, this was a huge win for farmers when it comes to farm programs and crop insurance. But the Farm Bill is also still out there that we have to get approved and put into law. I believe if we keep this momentum going, I believe we've got an opportunity to provide even more support to agriculture.
Now, along those lines, Jeremy, and I'm going to ask you to pull out your crystal ball on this one. Do you think that the passage of this act improves the likelihood of getting a complete farm bill passed, or do you think it takes some of the wind out of the sails?
Ooh, that's great question. And thank you for prefacing that by crystal ball. So I'll typically spend a week a year in DC meeting with the House and Senate Ag Committee staffers. And we're very fortunate, right? From a farm credit perspective, our mission, our commitment to production agriculture and rural America allows us the opportunity to have these kind of discussions with staff that have a direct impact on getting the Farm Bill passed. And so I believe that what was accomplished in this bill addresses a lot of agriculture's asks, but there's still some areas that need to be firmed up or some opportunities that we have. So I'm going to say, because of how this bill was, the collaboration, the support within Congress, I believe that we're probably closer today to the passage of a farm bill. Again, you're asking for my crystal ball. Just looking at the momentum, looking at the commitment to agriculture, to rural America as a whole, I believe that we're a little bit closer than we were maybe a year ago.
Okay, that's fair. I see that we're at the top of the hour and I want to be respectful of time, but I'll ask one more question. Obviously, we've all watched, perhaps with dismay, a lot of cuts to federal agencies and like USDA in particular, that has resulted in personnel, losses of personnel, less grant opportunities, service centers being more strapped for help. Does this One Big Beautiful Bill Act help that at all?
Dario, do you have any insight there?
As far as agencies, I can only speak to, certainly from an IRS perspective, a lot of folks have taken buyouts, et cetera there. So too early to tell whether or not, what the impact is there from a customer service on the phones perspective, for example. Things could take some time to remediate for resolutions there, but no doubt about it that the IRS, for instance, has had some staff go elsewhere through early retirements, reduction of probationary employees, et cetera there. And so one of the keys, that we'll have to wait and see is some of the guidance that needs to come out of this bill, if that gets impacted or not. Because they'll have a pretty good hurdle to begin to provide guidance on a lot of these things that are coming out of this for taxpayers and their advisors to properly adhere to the provisions that have been right now signed into law.
Okay, great. A couple of final housekeeping notes. One is that we will be posting the slides and the recording of this on farmcrediteast.com/webinars. That's our webinar page on our website. All our webinars, past, present, and future, live there. We archive recordings of past webinars and we put announcements of future webinars on that page, so take a look at it. With that, I think we will call it a day. Feel free to reach out. The contact info is on the screen. Feel free to reach out with additional questions. And with that, I think we'll adjourn.
Thanks. Sounds great, Chris. Thank you.
Thank you, everyone, for joining.